Good Monday morning, Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from somewhere special in the city of brotherly love, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Good. You know your Eagles are playing today.
Yeah, the Vikings.
Yeah, and one of our favorite chameleons, right? Swami, is from Minnesota area or Minneapolis, Northwoods. So I'm thinking I may bet a pizza pie against it. Take the Eagles. Nice. I don't know who's favorite in the game. Any idea who's favorite? I have no idea.
I don't know. I'm not sure.
My guess it's got to be pretty close, the game. Yeah. Some major stuff going on in the market this morning, huh?
So yeah, before we get started, you want to read the disclaimer? You want me to?
You can do it. It's up there.
Okay. All right. Before we get started, everyone, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
All righty.
And I will share my screen real quick.
Tom Petterfee was on CNBC this morning.
What did he say?
He was very, very bearish on the market over the next couple months. Sees a lot of risk to the downside.
Okay. Well, a couple things going on right now. We know, this week, we're expected to raise interest rates here. I think Bank of England, Bank of Japan, a lot of developed nations and undeveloped are looking to follow suit. So we're seeing central bankers taking liquidity out of the markets, increasing the cost of capital, and that will weigh on stock valuations, right? And on the economy as well. Couple things. The other thing I think that I'm looking at is that the central bankers have identified deglobalization as an inflationary factor, and that we saw the start of deglobalization kind of with the war in Ukraine and Russia, and now we're seeing the situation in Taiwan is not improving. I think yesterday President Biden was on 60 Minutes, said that America would intervene militarily if there was an issue or China decided to invade Taiwan. So those are, I think, indicators of deglobalization, becoming a wider problem, more widespread, and that creates inflationary pressures, right?
Yeah, for sure.
More like now we might not be in a military war, America directly, but we are in a Cold War, right? And in a Cold War, there are things happening in the background that we don't see, but what's happening is the countries are trying to weaken each other's economies, political systems, social systems, and that's probably intensifying in the background. We don't really see it. We don't read about it, but probably things like that are happening already. And
for sure. I think one of the reasons behind that CHIP Act was to get chips made onshore again.
Right.
They're very worried about, escalation in the global tensions and what may happen if China invades Taiwan. And I mean, you listen to Russia and they're at war with the West, right? The West is supplying the weapons that's causing problems for them in Ukraine.
So Putin said we're at the war with the West. America, I think, already gave $15 billion worth of aid, something around there to Ukraine. So we're invested, right? We're invested in it financially. We're invested in it politically, militarily, and they see it. So whatever war it's not just being fought on Ukraine's soil; it's being fought in the background in things that we don't even see, right? And we probably will start feeling it, or maybe feeling that right now. And now China, that's also becoming an issue. And, it doesn't seem like whatever is happening is not making the situation better there right now. So let's take a look at the pre-market report before we get started on on the rest of the show. But we'll take a look at the pre-market report, see what's trading the pre-market hours. I did talk about looking at cross-asset trading. So I'll start out showing maybe like a simple example of a trade setup that's cross-asset. If we do have questions, if you guys have questions, you can put that in the live chat. Will's watching it, he'll read it back to me. If you do want to come on the show and ask your question live, we'll also put out a link to Zoom. Click on that link, takes you over to Zoom. Once you get to Zoom, there's a button, raise your hand. Click on that. We'll be able to hear you. You don't have to turn on your video camera, but you could ask your question live. So let's start out right now with the pre-market report. I'll move on to the cross-asset example. If we have questions, will stop me and I'll take the questions.
Perfect.
All right. So here, this pre-market report. These are stocks trading at pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. We see 37 stocks made our percentage gainers list, 139 on a percentage decliners. So from that perspective, we're looking like we're setting up for more bearish buys at the open. I'm going to filter out this pre-market report to just S&P 500 stocks. We're going to take out any ETFs in the list, leverage products, closed-end funds, preferreds, units, rights, all those. Let's take them out just to see what's going on in the S&P 500 companies. And to do that, I'm going to use the filter here in ETF and drop this down. And what this does is by selecting one of the ETFs, it's going to filter out the list by the holdings in that ETF. So SPY, that's the S&P 500 ETF. We see 3 stocks made our percentage gainers list, 19 on the decliners. So here, showing the same thing, like we're setting up for more bearish bias at the open. So if there are no questions right now, what I'll do is go to an example to show what a cross-asset trade would look like.
Perfect.
All right. And let me start out. I'll start out with, let's say, IWM. And a lot of times when we talk about spreads, doing one, buying one thing, selling another, we talk about option strategies that are within the same underlying asset. So it will either be like a call spread. So a call spread is a vertical spread where we buy, let's say, one call, right, on one strike and sell another call on another strike. And then when we analyze it, we could analyze it from different perspectives, but one way we could analyze it is the IBKR, which compares the implied volatility vertical skew. How does the implied volatility of one strike compared to the implied volatility of another strike? So you could see that this has a vertical skew as the prices of the strike prices go up, implied volatility is coming down. As the prices of the strikes goes down, implied volatility goes up. And we could measure it by days left to expiration and how far the strikes are away from the spot price. So this way we could see what the vertical skew looks like in a particular underlying asset and compare that to what it usually looks like. So we could do it for call spreads, put spreads, butterflies, all types of spreads, even calendar spreads. So a horizontal skew would look something like, between different expirations. What is the skew? What is the implied volatility in a near-term option or shorter dated option versus a longer dated option? And mostly we talk about that because it's easier to kind of understand within one underlying asset. But as you expand your trading knowledge and your trading models, your trading operation, you'll start to look at cross asset pricing as well. So cross asset would look something like, and I'm going to try to just set up a simple example, right? So I'm just showing this just as an example as we're doing it, but I'm going to use these benchmarks here. And here's IWM. I'm going to go to a benchmark for a straddle. And this straddle benchmark is looking at the money 30-day option, right? So it's a synthetic 30-day option at the money premium. And here it's saying that right now, if you bought the synthetic 30-day at the money straddle, it would cost you 6.6% of the stock price. So in other words, the stock would have to move 6.6% next 30 calendar days for you to break even. If it moves more than that, it would be profitable. Less than that, it wouldn't be profitable. Okay, so 6.6% of the spot price. And historically, we see in the last 52 weeks, it moved 6.1%. So that's versus itself. We can try to find other assets, other risk assets that we think are closely related to it and compare how does this straddle compare to something like SPY. All right, so I think I brought it up here. Let me see SPY. So here's SPY. Yeah, I'm trying to simplify this. All right, hold on. Let me see if I could put them next to each other. Let me see. All right, here's kind of next to each other. So we see here that SPY straddle, 30-day straddle, right now will cost 5.6% of the spot price. So SPY, next 30 calendar days, would have to move 5.6% in either direction to break even, right? If you're long the straddle, it has to move more than that. If you're short the straddle, it has to move less than that. And the 52-week average is 4.6. So we could kind of see here and just compare these two right now, how the straddles match up. So right now, SPY is trading 1% above its 52-week average. IWM is trading a half a point, right? A half a percentage above its 52-week average. The 52-week average, IWM versus SPY, there's what is that, 1.5% differential usually. So IWM on average trades 1.5% above the SPY. Right now, it's 1%, right? So 5.6 versus 6.6. So now we're getting a general view of how they traded versus were priced versus each other historically versus now. So that means that right now on a relative basis, IWM is priced by only 1% above, right? Usually 1.5, now it's by 1%. And there is obviously there's risk in it, because if you buy one straddle, sell the other, one can move, one cannot. Maybe one will stay unchanged. So that would be the worst scenario for you, is that you sell, let's say you sell SPY straddle, buy IWM. After a month, IWM could be exactly at the same place. So then you would then you would lose the entire premium on that. And if SPY moved, you know, outside the range, then you would lose. You'd have to buy that straddle back higher, right? So those are obvious risks there. But the idea is looking at the straddles, and if you have an opinion, if you think, hey, they're going to move to 1 beta, right? If they're going to move, you think at 1 for 1, then, which looks to me like the markets are starting to set up. So that's why this straddle is coming in relative to this one. Then buying SPY, selling IWM, you would make a 1% differential, right? If you thought, especially if you thought both of them were going to sit there, then the IWM is a sell versus SPY buy. If you think that they're both going to move in the same, 1 beta, then IWM is a sell, SPY is a buy. So there are outlooks, that you have when you start trading across assets, and you have to understand those risks. But the idea is, okay, how are they setting up now versus historicals? And if I do that trade setup, is it consistent with my outlook in the market? Okay, and if it is, maybe there's some edge in that spread. So is that kind of making sense so far? What I'm saying? So you're buying one, selling the other, right? As a hedge.
Yeah, seems good. No questions.
Okay, and we could take a look from a historical perspective how these stocks tended to move versus each other. So let's take a look at. I'm gonna go here on a price action analysis tool. So let's see here. And here I have already IW set up, and let's do a period of in the last 4 years. Let's just do, what is it, like 22 days, trading days in a month, 30 days. Let's do it 22 days. I'm going to compare that to SPY. So here we could kind of see how in the same period, right, in the last 4 years, over a 22-day period, how they actually moved versus each other. And we have a bunch of statistics kind of here to help us out. We could see that, IWM had 58% positive occurrences versus 67. These are the negative occurrences. So they don't always move in the same direction, right? So sometimes one could be up, the other could be down. But from the perspective of a straddle, that won't matter, right? Because a straddle is based on how far it moves. Here's the average move over the period. So SPY tended to do better in the last 4 years. Here's the median move. So you can see SPY, the median move was higher in SPY than in IWM. If we looked at just the positive moves, all the positive moves, we see that IWM on average was up 5.9%. If we just took positive moves versus SPY, 4.1%. The negative moves, the average moves are 6.4% versus SPY 5.2. But keep in mind that they don't always move in the same direction, right? So they can move in opposite directions of each other. The biggest move to the upside over a 22-day period in the last 4 years, IWM 17.2% versus SPY 11.6. To the downside, 21.5 versus SPY 12.2. So here you do get some significant divergence, right? As far as those extreme moves go. And those are things that you should start to consider if you start trading things that are cross asset. And by the way, I'm just showing a straddle, but you could set it up with, calls or call spreads, put spreads, risk reversals, just looking for as one strategy, comparing it to each other. Let's take a look at down here. And here, this is the absolute average move. So here, this is taking IWM over a 22-day period. If we converted all the moves to absolute average, so all of them to positive, took the average, that's 6.1% versus SPY 4.5%. So here you could see about 1.6% differential, right? 1.6, which is kind of in line with the historical averages. What did I say? It was like about 1.5%. Well,
yeah,
differential. So that's pretty much in line. So I guess, I want to maybe stop here, take questions, but I don't want to go to another strategy, because the idea here was to take a simple strategy and kind of introduce a cross asset valuation.
All right. Does anyone have any questions relative to Dimitri's early discussion on cross asset trading? We are we're a couple minutes actually delayed. Actually, there were some nice comments from Rob today about your previous IBKR webinar. So I did put a link into it. All those webinars sit somewhere on the Interactive Broker library. So you just go register and you can view all the old webinars. So thanks for the shout out, Rob.
Yes. No, thank you, Rob. So yeah, so that's one of the ideas behind why we benchmark, different types of strategies, because certain strategies, you could compare just against itself from a historical perspective. You could also compare it on like products. And when we talk about cross asset, a very popular strategy is the volatility dispersion. So you might hold a basket of long volatilities versus selling an index, of short volatility. The idea is that the dispersion of a long basket of long volatilities, stocks might go up a lot, some might go down, but selling the premium in the indexes will not move as much, or the other way around. So when we talk about, you guys could go read more about it, but volatility dispersions would be cross asset type trading.
Hey, D, we did have a question that popped up from Laurent. He was asking, it doesn't include correlation and beta. Is this question?
Yeah, so this doesn't, no, because what I'm doing is just kind of introducing to you the concept, right? So you wouldn't be able, I'm just showing you two different types of assets and two benchmarks as a starting point. But yeah, you would have to build out a model for it, because there's too many different strategies. So imagine how many different spreads you could create, how many different, within one underlying asset. You have butterflies, call spreads, iron condors, ratio spreads, calendar spreads, diagonals. Once you go cross asset, that just multiplies.
Yeah, actually, I think Swami said it best. He said lots of options in options.
Right, lots of options and options. And as a portfolio, though, you're going to end up having cross asset portfolio, right? You're going to end up having, long Vegas and short Vegas and long gammas and short. And it's important to kind of, even within your overall portfolio, be able to evaluate the sensitivities of that.
Perfect. All right, we'll leave it there, and I guess we'll continue on tomorrow.
Yep. So thanks everyone for joining. Stay safe out there. Have a great trading day, and hope